In this video, I'm going to explain how to estimate the equity cost of capital. The equity cost of capital is a part of overall cost of capital. If you remember from earlier videos, we have made very simplifying assumption that there are only two sources of capital. One is the debt and other source of capital is equity. So if you have only two sources of capital, then how do you calculate the overall cost of capital? So the overall cost of capital, or WACC, is the weighted average of these two sources of capital. The second source of capital is equity, and we must know the cost of equity if you want to calculate the overall cost of capital. That is why in this video I'm going to explain how to calculate equity cost of capital. Just to review what we have been doing, I have put this slide which lists the different steps we follow in order to compute weighted average cost of capital. And if you see here, the third step here is that we need to calculate the equity cost of capital if you really want to calculate the overall cost of capital. That is why I am going to explain here in this video how to compute the equity cost of capital. Let's see how we can compute. So here I have listed two different methods to compute the equity cost of capital. And you might see in some other textbook there are more ways to compute the equity cost of capital, but for our purpose, for this class, I am going to use these two methods to compute the cost of equity. So the first method is using Gordon growth model, and the second is the CAPM, or the capital asset pricing model. And for some of you, you might not know what is CAPM. If you don't know, I have another video which explains what CAPM is and how to estimate this CAPM model. Please watch that videos. But for this slide, I'm going to follow a softer version of CAPM. So let's start with the first method of finding the equity cost of capital. So if you look at the formula, how do you calculate? And here I have given the formula. So RE refers to cost of equity. So that equals to the dividend, right? The dividend times 1 plus G. The G means the growth rate, dividend growth rate, and the current price. So in order to compute the equity cost of capital based on Gordon model, we need to know all these different variables used in this equation. And to make our life simpler or easier, I have listed here different steps that will make calculation a lot easier or simpler for the first timers. So step 1, go and get the current price and current dividend. That's step 1. Step 2, based on the historical growth rate of the dividend, you can calculate the dividend growth rate. But I also said make adjustment. Remember, we are trying to compute the cost of equity, and it is a forward-looking concept in the sense that you're trying to calculate how much it costs if the firm wants to issue a new shares in the market or use its retained earning to fund its expansion. So it is all about the future. That's why whatever you might see in the past might not be in the future. That's why even if you calculate the historical growth rate of dividend, you have to make some adjustment based on the future prospect of the economy and the company itself. But that makes a little more complex, so we are trying to assume that history will repeat in the future, which is odd, but we're going to make that assumption. That's why for us, the future growth rate of dividend will be exactly the same rate of past rate of dividend growth. And in step 3, what you do, once you have all these variables calculated, you can use the equation that we have. Cost of equity equals to dividend paid in 1 year over current price plus dividend growth rate. And keep in mind though, use at least 5 years of data, and if you are using quarterly dividend, don't forget to annualize that. So let's see how we do. And I have an example for you, and I'm trying to calculate dividend growth rate for 3M company, and I have listed the information here, but how you can get this information is through Yahoo Finance. So what you can do is, I have used that information, so you can go to Yahoo Finance, and once you are in the Yahoo Finance page, what you can do is there's a lookup box. You can type the name of the company or ticker symbol. So for us, it's just the 3M company. So I'm going to type 3M here and then click on Go. Once you're on this page, you have the information about the 3M company, the summary, and there are many other tabs. You can click on each of the tabs and see you get different kind of information. And for this example, I'm just clicking on historical data section, and then you can choose the date that you want to, and you can choose the historical price or dividend only, and whatever information you want to get, you can get most of the time from Yahoo Finance, and that is what I am using here. But I have just the screen shot from that section, so let's focus on here. So we have here the stock price is 184.84, right? And we need to calculate the dividend growth. That's why I have a screenshot from the dividend payout. So I just got the information that we need for this purpose. So right now I have a dividend paid during 2000 and dividend pays during 2016. And what time period you want to consider, it all depends on what your objective is. And for me, in this example, I'm trying to estimate the long run dividend growth rate for this 3M company. That is why I am using at least the 15 years of data. So now you have how much dividend was paid in 2000 and how much dividend was paid in 2016. Based on this information, you can calculate dividend growth rate. Let's see how you can do this. See here, how much dividend was paid in 2000. So you can see in 2000 dividend was paid 4 times, each time 29 cents. So 29 cents times 4, that means the total dividend paid in 2000 was $1.16. How much dividend was paid in 2016 then? So again in 2016 dividend was paid 4 times and each time $1.11. That means 4 times of this $1.11 is going to be $4.44. That means the total dividend paid in 2016 is $4.44. Now once you have this dividend paid in the beginning period and the current period, you can easily compute the dividend growth rate. And how can you compute the dividend growth rate? Remember the formula that I listed in earlier slide. Current period dividend over the beginning period dividend to the power 1 over number of period minus 1. That is what exactly I have done here. You can see the current dividend is $4.44 and the beginning period dividend is 1.16, and to the power is 1 over 16 because there are 16 years minus 1, and that gives me $8.75. That is the dividend growth rate in the past 15 years. Now the question comes, is this going to be true for the future? You can argue in a different ways. maybe in the future that might not hold. Maybe it might hold. It's a very open questions when you are going to do a real analysis or real world problem. But for our case in this example, I am assuming that whatever dividend growth was there in the last 15 years is going to hold for the next so many years to come. So if you have that information, now how can you calculate the equity cost of capital based on this Gordon model? Now I have relisted here some of the information: current price, long run dividend growth, and current dividend, and next year dividend, because we need that next year dividend to compute the cost of equity. And how do you calculate next year's dividend? It's simply the current year dividend times 1 plus the growth rate of dividend, right? And that gives us $4.8285. That is the dividend for the next year. And now you have all the information you need to compute the cost of equity. Now you can substitute these values in the equation as I have done here, right? The cost of equity equals to the dividend that is going to be paid next year over the current stock price plus the dividend growth rate. And if you simplify this equation, you are getting 11.36%, which is the cost of equity. What does this mean? That means, let's say the 3M company wants to fund its expansion using its retained earning, then the cost of that retained earning is 11.36%. That is method 1. And I think it is simple. You can do it. Now let's focus on the second example or the second method. So we can also compute the cost of equity capital using CAPA model. Again, for some of you, it might be new. I'm trying to give you the softer version of CAPA model. So how do you calculate cost of equity based on CAPA model? So again, I have given you the steps so that you can follow and it's easier to compute. Step 1, you need to know risk-free rate. How do you calculate risk-free rate? What is risk-free rate? That's a very open questions when you have to deal with the real situation. So most of the time though, people often use treasury security rate of return as the risk-free rate. I'll explain this later. And second step, you compute the market risk premium, which means how much will be the overall excess return of the market in the future. It's not about the past, it's about the future, and nobody knows how much will be the market risk premium for the future, but most often people use historical market risk premium as a proxy for future market risk premium. And then you need to compute the firm's beta or the equity beta. How to compute that is off the table for us. I'm going to use Yahoo Finance beta, but if you are interested, look at my video that explains how to estimate CAPA model, and that also explains how to compute beta. But for this case, for this particular example, I'm going to focus on the beta that we can find on Yahoo Finance. And finally, once you have all the information that is required, you can put this all into the equation and compute the cost of equity. And that CAPM, or the equation to compute the cost of equity capital based on CAPM, is this: cost of equity equal to risk-free rate plus equity beta and market return minus risk-free rate. Remember this equation, and this is one of the most widely used equation and is also called CAPM, or the capital asset pricing model, and this is used in so many ways, but this is only one use of this CAPM. We are using this CAPM to compute the equity cost of capital. And I just have some tips for you. If you were calculating beta yourself and instead of using Yahoo Finance beta, you would consider few things. Like I have said, use 5 years of monthly data, historical data. Keep in mind that the value of beta depends on the frequency of the data and the time period you consider. The more on how to compute equity beta is explained in my another videos. Please watch it. Now what I want to do is I want to move forward and then calculate the equity cost of capital for this 3M company using CAPA. Again, I borrowed that information from Yahoo Finance, and here I have the beta. Most often these Yahoo Finance page has equity beta, and I'm going to use this beta is 0.93. And what is used as a risk-free rate? People have different opinion, and for this, for example, I'm going to use yield on the 5-year treasury note as a risk-free rate, and for now it's 1.918%. Now we need to compute the market risk premium. Again, what is market? How to compute market risk premium is very open for discussion. You can use different indexes as market proxy, but for this case I'm going to use S&P 500 as a proxy for the market. Now the question is, how much will be the future market risk premium? Nobody knows, right? So how to compute then? Most often people use historical market risk premium, and I'm following that tradition. So what I'm going to do is I'm going to look at how did this market do in the last 5 years, and I'm going to assume the market will continue to do that in the next several years to come. In this case, I'm going to use last 5 years market return as a proxy for future market return. So I have here the S&P 500 index value in 2011 and S&P 500 index value in 2016. So if you have that indices for the 2 years, then we can compute the market return as we did for dividend growth, and now the market return is 12.23%. Now we have everything we need. Based on this information, now we can go and calculate the equity cost of capital using CAPA. And I have relisted the information here: risk-free rate, equity beta, market return, and market risk premium, which is excess return. You have the market return minus risk-free rate. That gives us the market risk premium, and once you have all this information, just plug this value in, right? The cost of equity equals to risk-free rate plus beta times the market risk premium. And if you simplify that, then you have 11.51% the cost of equity. Again, what does this mean? That means if 3M company wants to fund its expansion or its new project using its retained earning, or maybe issuing new shares, then the cost of equity for that purpose would be 11.51%. I hope it makes sense. Thank you.